Hello everyone. This is the first of a series of videos that I'm going to be doing on pricing and financial derivatives like forwards, options, etc. So let's get straight into it. I'm going to start by mentioning some assumptions that we're going to be dealing with throughout the videos. They're not true in general life, but they're good enough of an approximation that it gives us a good understanding and a good idea of how things work. If we weren't to assume these, the math would be too complicated to do anything, so that's why we're using these assumptions. Let's get straight into it. First one is that there exists a riskless investment that's gonna give us a return that's compounded continuously at a constant rate R. What does that mean? That means that, say, a government bond, we can buy a government bond, say, for MT, at time t smaller than t, small t smaller than big T, and at time big T, it's gonna return us this. R is going to be constant, and this is the return that it's going to give us. I'll explain a bit more why this E comes into play. And we're also going to be assuming that the lending and the borrowing rates are exactly the same. That is, if you want to borrow money from someone, or if you're giving money to someone, say in a bond or anything, this R is the same for both sides. We're also going to be assuming no trading costs, no transaction fees, that kind of thing. We're going to be assuming assets are infinitely divisible. Like you can have a third of a stock, or you can have 1.34567 euros. Okay. You can short sell any asset. What that means is that you can own a negative amount of any asset. With money, that's easy to imagine. You can have a loan, right? You can ask for a loan, and then if you spend all that money, now you have zero amount of money, but you owe money, so you have a negative amount of money. In stocks, the way this works, the short selling, is that, for example, a stock or a currency, is that I borrow a stock from someone. Usually it has a trading cost, a commission or a fee, but we're not going to worry about that. I borrow it from someone, and then I sell it to someone. So then I obtain some amount of money, but I have a negative amount of that stock. I have -1 stock, which I then have to buy in the future to get back to the person who borrowed it to me. So that's how short selling works. I'm not going to mention this one too much. And then the principle of no arbitrage, which we're going to mention a bit in a bit. Now, to explain why this is the case, this thing here, why continuous compounding gives us this, well, this is just because imagine we agree that, imagine I buy a bond at time small t that's going to pay up at time big T with the rates R. They can either pay me everything at the very end, which is going to give me, I have this at the beginning, and it's going to give me 1 plus R t minus t, right? This is the rate per unit time, and this is the amount of time that I'm giving this money to someone. So this is the total amount I'm going to be paying. But also, I could say, oh, why don't I divide the time period into 2? So then, I'm going to be paid this. Actually, let's write this the other way around. Actually, yeah. I'm going to get paid this halfway through, and then I'm going to reinvest this for the second half of the period. So this is going to be multiplied by the same coefficient. So I'm just going to write that as a squared. But I can also do that with n intervals. Instead of just 2, divide my time interval into n. And so the amount of money I'm going to get at the very end is mt times 1 r t minus t over n to the power of n. Now, as n tends to infinity, which is the same thing as saying I chop up my time interval into very, very small pieces, so the time intervals in between get extremely small. That's why they're continuous. This is going to tend to mt times e to the r t minus t. That's what it's going to tend to. Now this is some real analysis for any math students, but yeah, that's the limit. Okay, so that's why this thing came into play. I'm going to rub this out to free some space. Now, I'm going to be explaining, I'm also going to rub this out to be honest. Let's just write. I'm also going to be explaining the concept of no arbitrage. So an arbitrage opportunity is basically an opportunity that's too good to be true. It means that I can start with, well, I'm guaranteed to make money out of a trade with starting with zero amount of money. So I have zero or less, or I'm in debt. And then at time in the future, I'm guaranteed to make money. So in math terms, this means that if I have a portfolio that's worth xt smaller than or equal to 0 at time small t, then at time t, this thing is going to be worth guaranteed a non-negative amount, but there's also a positive probability that it's worth strictly greater than 0. So that means that I start with less than or equal to 0. Now I'm guaranteed to not lose any money. Guaranteed, this is going to happen. xt is going to be greater than or equal to 0. And then with some positive probability, maybe not, I'm going to be able to make some positive amount of money. So this is an arbitrage opportunity. We're going to assume that this doesn't happen. The reason why is because this, in real life, again, does actually happen, but the market closes the gap immediately. There are people whose entire jobs is to find these opportunities and exploit them super fast, and we're going to assume that we're not that fast enough. Like, these people are much faster, and we aren't going to have access to these opportunities. So I'm going to write this down a bit closer so I have more space. Time t, xt, guaranteed, and then maybe I'm going to write down. Okay, so now we're going to start with forward contracts. What are these? This is a two-sided contract. One side is called the holder. On the other side is called the writer. Another word for this is long. Well, we're going to say this is a long position and this is a short position. Two-sided contract. The holder is going to have a right and an obligation to buy a certain underlying asset, which can be stock, currency, copper, corn, anything. Underlying assets. It's going to have a right to buy that underlying asset at a specified price that they agree on, which is going to be called Ft. We're going to call this price Ft, a small t. And it's going to have a right and obligation to buy at this price. The writer is on the opposite side. It's going to have a right and an obligation to sell the asset at this price. Again, at a specified time in the future, which is going to be, say, t greater than t. Now, there are two types of forward contracts. Some that are cash settled and some that you have to physically deliver. So, for example, imagine this is for copper. Imagine I want to guarantee. Imagine the price of copper is maybe very volatile and changing all the time, and I'm making an agreement with someone else to buy copper at a certain price in the future that we agree now, right? Imagine, for example, I'm going to put an example with this. Apple right now, you can also do it with stocks. It's trading, I think, about, well, to make matters simple, I'm going to say it's trading at 100. Okay, right now, at time, small t. Time, t, right now. And say I really want to buy Apple stocks in the future, but I don't have enough money now. But I don't want the price of Apple to go really high, because then I won't be able to buy it. So what I do is I ask someone else, imagine, to let me buy an Apple stock at a time in the future, say 1 month later, at a price 120. So in 1 month, I have to buy at 120, and the other person has to sell at 120. This means that in the future, if the price of Apple is actually 130, I'm going to be buying a stock that's worth 130 for 120. And the other person is going to be selling a stock that's worth 130 for 120, which is the agreed upon price, which is called the forward price, by the way. And T, big T, is called the maturity date. Right now is the present, and then the price, the moment at which we're going to have to deliver is the maturity date, which is big T. And this underlying asset in this case is Apple, an Apple stock. So here's where the concept of payoff comes in. I'm going to write it down over here. Payoff. Payoff is how much money I'm making from the contract at maturity. So for the holder, the one who has the right to and obligation to buy, he's going to be making ST minus FT, right? He's going to be buying an asset for FT that's worth ST. So he's going to be making this amount of money. And the writer is going to be making FT minus ST. Whatever money the holder is making, the writer isn't making, by the way. It's a two-sided agreement, that's why. So if you add these up, it's going to be 0. Now, depending on the type of contract, at the maturity date, you can do two things. First, you can actually, and this is agreed upon as well at the present time when you're forming the contract. The person who has to sell the stock can either actually have to sell the stock, or if it's a copper or gold or something, has to actually deliver the gold at the price that they specify. Or they can just do the math and say, well, I'm going to be making from this deal this amount of money. And I'm going to be making from the deal this amount of money. Instead of me having to physically deliver the gold to you, for example, let's just agree that I'll pay you this amount of money. And that's what's called a cash settle forward contract. And the other type where you actually have to pay up what you owe. So if it's stock, give that stock, or if it's gold, give that stock, give that gold. Then that's called physical delivery type of contract. Okay, so now I'm going to be rubbing this example out. And then we can see here that the payoff, if we draw a graph, yeah, that's good. Let me draw that down. FT, ST, payoff. The holder is going to be making this amount of money at time big T, and this is the amount of money that the writer is going to be making. Okay? This is just plotting this, the payoff, with respect to the ST. I don't know if I mentioned this. I mean, well, ST is the price of the underlying asset at time big T, and ST, so ST, price of underlying asset at time T, and ST, big T, is going to be a time big T. So this is the maturity date, T is more than T. So this is the present time, and this is the maturity date. So this is the amount of money that each is going to be making, the payoff, at the maturity date. Now you can see that the writer can only make this amount of money, right? But it can lose basically infinitely amount of money. Whereas the holder can make this amount, can lose this amount of money, but it can make a lot more money. This means that the writer is exposing itself to much more risk. And so there's a concept called being naked or being covered for the writer. If the writer actually has the stock, it may lose a lot of money by selling the stock really cheaply, but it's never going to have to buy the stock again. So let's give an example. With the Apple example. Imagine I'm the one who has to deliver, so the writer. It's right now trading at 100 at time T. And we say that at time, say in a month from now, I'm going to have to pay up, give a stock for 120. If I actually have that stock with me, I own it, and the price goes up to say 3,000, then I'm going to be losing the opportunity of making 3,000 bucks because I'm only going to be selling it for 120, but I'm not going to be losing any money because I already had that stock. But now if I come into this contract with no stock, I say, yeah, I'm gonna deliver that stock at 120. I'm saying I'm gonna make money. 20 higher than 100, I'm gonna be making money. And then suddenly the stock goes up 3,000. Well, now I have to buy a stock that I don't have for 3,000 bucks, which means that maybe I don't have 3,000 bucks and I won't be able to deliver. Which means that there's two types of ways you can come into the contract: naked, in which case you can lose a lot of money, or covered, in which case you're losing the opportunity to make a lot of money, but you're not actually losing the money. Well, you're losing the money, but you're not in debt in a way. Okay, so that was just a bit of an introduction to what the writer can do or not do. Okay, and then finally, the last thing I want to mention before we value this: the forward contracts in general don't cost any amount of money to come into that contract. So the holder isn't paying anything to the writer isn't paying anything to the holder. They just agree to come into this agreement. Now, from this that I said, you might think that the writer has a lot more to lose than the holder, but that's not actually true. And now let's actually show why that's true. Okay, so I'm going to leave all of this, I think. So the way we're going to value this is we're going to use this no arbitrage rule. So we're going to build a portfolio. Suppose that at time t, I come into the agreement as a writer of a forward. And I have to deliver it a price ft for an underlying asset. That's going to be S. We're going to call it S. And at a time t, maturity date t. And now suppose, I'm just building a portfolio here. Suppose I also buy a stock, say the underlying asset, say it's a stock, and it's going to have a price ST. So I'm having to pay ST, this is in cash, for one stock. So I have one stock. Whenever I don't write anything here, it's just going to be cash, right? So I have this amount of cash. Again, I come into this contract, buy a stock, and then I've spent this amount of money. ST is just the price of this asset at time t. Now we arrive at the maturity date, time big T. I still have this forward contract. Now this cash, I've used it in the riskless investments. I've bought a bond or something, and now it's worth minus STERT minus T, right? It's more like I've asked for a loan of money, right, to buy this stock, and I've had to pay interest on it, so I actually owe a tiny bit more. And then I also have this stock, which is now going to be worth S big T. This was worth ST at the very beginning. So by the way, the total of this is going to be 0. As I said, the price of a forward contract is 0, and then these two balance out. I've bought a stock, but now I have a negative amount of that money. Now let's look at the value of this thing here. I've got one stock that's worth now S big T, but because of my contract, I have to sell it at FT. So I make FT out of this, and then I'm left with this. So I started with zero amount of money, and now I have this. By the way, this is cash, and this is sort of like the value in cash, 0 cash. But now if you look at no arbitrage, we're starting with a non-positive amount, so less than or equal to 0. And here, regardless of how much this stock is worth at the end, we're guaranteed to make this amount of money. So by the principle of no arbitrage, this has to be smaller than or equal to, let's write it down here, ft minus ster t minus t has to be smaller than or equal to 0. Because otherwise I'd be making guaranteed money for nothing, which we say can't happen. Okay. Now consider this same portfolio, but instead of being a writer, I enter into the other side. Oh, I forgot to say this, sell. Anyway, I'm a holder, so I have to buy that stock, not sell it. And instead of buying the stock, I short sell one. So again, short selling any asset. I own negative amount of that asset, so then I obtain positive amount of that cash. So I'm taking like negative of all of this. I'm doing the opposite portfolio. Then here, at the very end, I'm going to have negative this amount of money. Why? Well, I have minus the stock. I have a forward that I'm a holder in this second portfolio, and I have plus this amount of cash. So the cash is going to be this. And then I'm short of a stock. I've got minus one stock, which I'm going to have to buy at FT, at the specified price that we agreed upon. So I'm going to have this amount of money. And if you add both of these up, again, it's going to be 0 because it's a two-sided agreement. So whatever money one makes, the other one is going to make. And again, we started with 0 here. So we're building the opposite portfolio. We have the negative of the results. And so we get this inequality, that this has to be smaller than or equal to 0 as well. So putting these two together, we arrive at the conclusion that ft equals ster t minus t. So that's the price of the forward. Now there are several things to mention here. First of all, notice that the value or the price with no arbitrage does not take into account whether the underlying asset is overvalued, undervalued, predictions of the future. It does not take any of that into account. It just depends on the current price of the underlying asset, the one when we make the agreement, and then the interest rate, and obviously the time, the amount of time that passes. So it does not depend on S big T and anything surrounding S big T, whether it's going to be higher, lower, etc. This is the value if we're assuming no arbitrage. So if this wasn't the value, so say if we agreed that FT was a different amount than this, say it was smaller than, then one of these sides would be making guaranteed money. If FT, for example, was smaller than or equal to ST, we'd have this side is making guaranteed money. If the opposite thing was true, then this side would be making guaranteed money, which can't happen by arbitrage. Okay, so this is part of a forward, and now I also wanted to mention the difference between a forward and a future, which you might listen here somewhere as well. They're basically the same type of contract. A future also says you have to, well, there's a holder and a writer. I'll explain a bit more now. This one still has to buy an asset, this one still has to sell an asset. The difference is that forward contracts are agreed upon over the counter. So you find someone that has the same interest as you, so wants to be on the other side, and you come into this agreement. Whereas in a future contract, it's through an exchange. There's an exchange, a company that offers these contracts to people. They say, I offer you the contract to buy at this amount of time, and the company itself, the exchange, is the one responsible for selling. It's the other side of the agreement. And it also does the other side. It offers agreements where the other person is right to sell and the exchange buys. So it acts as the other side of the agreement. So in that way, it's more standardized, right? You don't have as much freedom because it's not over the counter. You have to agree with the terms that the exchange imposes on you. That's first of all. Second of all, you have to have a margin account. Remember that you can lose a lot of money, especially if you're the writer. So you have to guarantee to the exchange that you're going to be able to pay up. So you have to have an account with some amount of money that sort of the exchange looks at it and sees, okay, you can actually pay me if the stock does something crazy. And then, yeah, I think that's pretty much all the differences that they have. Yeah, I think that's everything I wanted to mention. Yeah, I hope you enjoyed the video, and I'll be doing some more in the future.